Yo, want to make a quick video on why you should not trade retracements. So, how many people on Twitter do you think were trading a long back into the range to then continue sells? And I warned y'all in the outlook, don't be one of those unless we see a H4 change in the state of delivery, or in my case, because I'm a bit more advanced and I know my model in and out, so I can go for intra-session plays. I want to see a beautiful H1 displacement. Did we get it here? Yes, right here. We had a little displacement. But I want to see more power because this is the high that rebalanced this fair value gap. I want to see a big fair value gap right here. Big displacement. Price with intent. And that's when you can long from a fair value gap back into premium. Now, let me go back. I want to show y'all something. Imagine you traded this unicorn. Sweep, unicorn. You put your limit on the breaker. Like I said, on the breaker, it's wick. After we have a displacement above it, then stops under the low. And then you hold this trade, let's see, for 13 hours plus 13 plus 2. For 15 hours, you're in this trade for 0.5 RR. Is that logical? No. Why is it not logical? Because we are counter trend trading, and usually when you trade the retracements, these are low resistance liquidity runs to get taken in the future. Not always. When I tell you guys something, it's not black and white. Trading is an art. You need to put all the pieces together. So if I see a low resistance liquidity run before London opens, I don't see intent in price, then I am not going to long. And how many people do you think were longing this morning because they don't have like a proper model like us? They're like, okay, we have this fair value gap right here. Let me trade internal to external, put my limit. I hope I get tagged in, or maybe they even put their limits right here on this fair value gap. Let me open up the indicator for fair value gaps. See this fair value gap? Their invalidation level would be low, high, low, high. I'm not even sure if it closed. Yeah, it closed, high, low. Let's give them the benefit of the doubt. But this is even a way too choked stop loss, because the H1 range is literally all the way down there. But still, let's give them the benefit of the doubt and have a tight stop loss. Right now, they would be trading for 0.47 RR. They're chilling in the trade for 4 hours. Oh no, less RR. 3.7 RR. Trying to trade the Judas swing of the week. That's why you don't trade retracements. That is why you don't trade retracements. Easy as. We have a low resistance liquidity run. We don't have intent in price. Where's the intention? Tell me, where do you see intention? I just see wicks. I just see liquidity being generated. For the smart people, take it in the upcoming week when we get a confirmation at our key level to short. Oh, I marked out the breaker wrong. That is how easy trading is. Less is more. So I don't know if any of you guys longed this, but if you did, watch this video 20 times as punishment that you longed a low resistance liquidity run without a change in the state of delivery. Now, I understand that logic. I understand if people want to catch every move, because we break this, so this is the new range from here to here. Then we break it, so this is the new range from here to here. And then we take our Gann box from high to low. This will be considered premium, and they want to trade the retracement to premium. But as I said, price can just do this, come back up, do this again, come back up, do this again. That's why you don't trade. You wait till price tips its hand to you. And how does price tip its hand to you? By leaving inefficiencies. Why does this mean it's tipping its hand to you? Because if you leave inefficiencies, that means there have been a lot of orders that pushed price in a certain direction. Price does not just leave inefficiencies for no reason. That is why if you studied ICT 2022 mentorship, you would realize what ICT is hinting about. The whole mentorship. The whole mentorship, he's hinting about swing highs, swing lows, so liquidity and fair value gaps. What more is he hinting at? Okay, this is the color. Let me remember it. I'm gonna change my colors right now with y'all. Let's see if this is clean. This is a bit clean. This is a bit clean, y'all feel me? I like the blue more. The red's a bit negative. On some positive baby colors. Alright, so where was I? Yeah, so ICT is hinting at inefficiencies and swing highs, swing lows, so liquidity. Fair value gaps, liquidity. And what are you trading? Breaker block, propulsion block, mitigation block, rejection block. Nah, G, just keep it simple. So this is a quick rant because I love y'all and I want y'all to make it. Look at this low resistance liquidity run. Hopefully, we'll take all this liquidity this week. Who knows, maybe in the future. Look at this. It's going almost at break even. The straight from the people that were probably longing. And that is why you need to trade when all the stars are aligning. Let's call it that. Let's see. Price could even, because look, how you need to look at price. These reclaimed order blocks, you can see them as mitigation blocks. So this reclaimed order block right here is going to be used by big institutions to mitigate positions by the algorithm. Because where else are they going to exit their positions? Obviously in order blocks or mitigation blocks, whatever you want to call them. And this is why when you trade the market maker model, then we have consolidation, this smart money reversal, like this. Always the left side of the curve usually aligns with the right side of the curve. Why? Because big institutions need to mitigate their losses because they are the ones that are moving the market efficiently. So they mitigate their losses at stuff like these arrays, these reclaimed order blocks, mitigation blocks, etc. I don't know, whatever you want to call it. And when you learn how to mark out the left side of the curve with the right side of the curve, a whole new world will open up. And it will be hard, and I don't want to teach y'all that right now. Right now, you just gotta trade the trend. That's it. And then when you get profitable, you can learn market maker models, etc. Everything. I hope this quick video helped y'all on why not to trade retracements. Keep your mental capital, keep your equity. Because imagine you just have your rule, stop loss or take profit, and you get stopped out. Who knows, maybe New York news is going to sweep it and then we're going to get a move up. That is also another thing. You use the economic calendar to frame high probability trade ideas. Trading days, excuse me. Is this session a high probability trading session? No news in London. It's a Monday. We are overextended. We have reached a drawn liquidity, which means probably a retracement or consolidation profile. And what do we see? A consolidation profile. Exactly. Good job. It's that easy. Let's see how many pips it moved. Let me open up this indicator. If I still have it. Ooh, I don't, I think. Unlucky. Let's just do it ourselves. 15 pips. 15 pips in London session. And people are trading this. If this worked out, let's say they thought this was a breaker pattern. Because you guys need to understand these signatures and price are getting left, so the noobs trade them. So how many people do you think shorted this? A lot. Let's see this. We have a low. Inefficiency, rebalance. We break above it. How many people do you think longed it here? How many people do you think broke their rules, longed it, going for the retracement play, and are now molding, losing their whole mental capital? 3 hours in a position that does nothing. You don't want to trade those. And if it was a win, they post it on Twitter. If it's a L, you don't hear anybody talking about it. And that's why you only trade high probability trading days like a professional, not like a little loser that is losing, and wins once and posts it on Twitter. Because I know that stuff affected me as well. Because I was like, damn, my model only gives me a few trades a week, and these men are catching 50 trades a week. My bad for the rant. I hope it helped y'all. And if you traded this retracement, your punishment is watching this video 50 times. Because that's not what I teach y'all. And obviously you need to learn from the mistakes yourself. But come on, man. Like, you gotta know better. You gotta know better. There are 4 market profiles. Expansion, consolidation, and then let's see, retracement. So this is the retracement. And then a full-on reversal. You want to trade the expansions. Easy as. All right, boys, take care. If you traded longs today, watch this video 10 times. All right, as punishment. All right, peace, boys. Ciao.